3 weeks into the Strait of Hormuz closure, the market settled on a comfortable consensus, a temporary supply disruption naturally moving toward a peaceful de-escalation. You can see this optimism priced directly into emerging market assets. Sovereign spreads haven't widened significantly, and local currencies are consolidating instead of collapsing. But the actual policy actions taken this week tell a drastically different story. Governments from Bangladesh to Zambia have suddenly announced emergency fuel rationing regimes. There is a precise mechanical difference here. A government that subsidizes an energy shock is signaling it has the financial capacity to cushion the blow. A government that implements strict fuel rationing is declaring total fiscal exhaustion. The market is currently celebrating the absence of a visible sovereign default event. It should be reading these rationing decrees as the first administrative step of precisely that outcome. Look at the International Monetary Fund's Article 4 baselines. These official assessments dictate the debt sustainability models for frontier nations. Every baseline relies on a fixed assumption that shipping lanes will remain open and energy import costs will stay predictably within range. This week's government-mandated energy rationing breaks that mathematical assumption entirely. These global macroeconomic models have structurally failed in the field. These rationing notices in Dhaka and Lusaka indicate that the financing mathematics of the IMF baseline have already been superseded by the physical reality of the energy shock. The current low volatility across these asset classes is deceiving. It is the treacherous stillness that occurs right before a violent, systemic repricing. Confusing the temporary absence of an immediate default with actual economic stability is the fatal error of the consensus market. We map the structural reality facing frontier sovereigns using an import ladder. When external shocks hit, nations rely on a descending hierarchy of financing mechanisms. The extended Hormuz shock has rapidly burned through upper buffers, subsidies, and reserves, forcing them down to the final terminal level. Bangladesh serves as the perfect diagnostic case study for the mathematical collapse happening on this final rung. The IMF's programmatic assumption for Bangladesh was clear. Its current account would be stabilized almost entirely by its robust garment export revenues. But look at the physical reality on the factory floor. Garment manufacturing is an intense industrial operation that requires massive, continuous electrical power to function. When the government mandates national power rationing, it physically halts factory production and completely severs the export supply chain. This triggers an unmodeled dual-sided compression. The state is hit with massive energy import costs at the exact same moment its dollar export earnings collapse. This simultaneous current account shock is completely absent from the IMF's debt sustainability analysis. This is not a theoretical tail risk scenario drawn up in a stress test. It is the unpriced operational reality happening right now. When a sovereign is forced to ration the exact power required to produce its primary export, its financial buffer doesn't merely bend, it physically shatters. The Hormuz shock functions as a strict geography tax, overriding standard fiscal policy. It zeroes in with brutal precision, penalizing sovereigns based on their physical location, specifically those with high import dependency, geographic isolation, and incredibly thin reserve buffers. Take the Philippines. Traditionally, its robust service sector and strong current account have insulated it from external shocks. However, its fiscal stability relies on a hidden vulnerability, a massive dependence on worker remittances generated entirely within Gulf state labor markets. As the regional conflict disrupts hiring and freezes massive project pipelines, it quietly severs the Philippines' primary dollar lifeline. This pressure forced the central bank governor to publicly admit policymakers are caught between fighting inflation and supporting growth. They are officially trapped in a stagflation cycle. The window for early positioning is rapidly closing. We see the same tax applied in sub-Saharan Africa. Zambia recently completed a landmark IMF-backed debt restructuring meant to secure its fiscal future. But Zambia's entire recovery math was explicitly modeled on the assumption of a stable global energy market. Now, Zambia is forced to burn scarce foreign exchange to maintain bare minimum energy supplies, completely abandoning the reserve rebuilding mandated by their program. By diverting those funds, they are executing a slow-motion administrative violation of their newly established fiscal restructuring path. The geography tax forces a choice between energy security and debt service, effectively dismantling the fiscal recovery paths established in official debt restructurings. This structural breakdown demands explicit asymmetrical portfolio positioning. The current stillness in sovereign spreads is an illusion, hiding an imminent chaotic repricing. We issue a strict caution against holding Philippine duration and local currency bonds. The central bank's admission means their projected easing cycle is dead. This creates extreme duration risk that standard yield carry cannot possibly compensate for. Investors should also take a broad underweight position on all Gulf-exposed, remittance-dependent sovereigns. The market has not modeled the second-order shock to their labor forces. Conversely, we are seeing a structurally massive market development. Chinese government bonds are re-rating. Chinese government bond yields are actually falling. For the first time since the 2008 financial crisis, they are functioning as a credible flight-to-safety asset. This unique strength comes directly from China's domestically anchored energy matrix. Its fiscal framework is actively protected by internal coal production, vast renewables, and sanctioned Russian crude imports. This re-rating as a structural war haven is entirely unique to China among emerging markets, and it remains vastly underpriced by Western allocators. But there is a final, completely unpriced tail risk actively shadowing the global macro landscape: the Taiwan Strait. Taiwan just announced a $2 billion Coast Guard reinforcement. This directly responds to the reality that the Hormuz closure playbook is actively studied in Beijing. This Coast Guard expansion serves as a sovereign credit signal, alerting the market that the Taiwan Strait is being re-rated as a strategic choke point in real time. The market absorbed the Hormuz disruption as an isolated, idiosyncratic event. It has completely failed to price the probability that strait closures are now a replicable geopolitical weapon. This upwardly revised tail risk is completely absent from all current Asian sovereign credit pricing models. When geography replaces policy as the dominant market force, the heaviest premium is always paid by the sovereign that forgot it was being priced by a map.